Good morning, you're watching All You Need to Know on Bloomberg Quint, India's first live streaming digital news service. Joining me on the show is Agam Vakil to talk about the futures and options space. But first, the trade setup. It was a volatile week and Friday was no different. If you look at the Dow Jones, that ended about 1.4% higher, but that saw a near 1,000-point recovery from the low to the high of the day. The European indices were in the red, with the Euro stocks declining as much as 1.5%. The FTSE, CAC and the DAX also declining more than 1% each. Asian markets have opened on a green note, but remember that the Japanese Nikkei 225 is on holiday on account of Foundation Day. As far as the SGX Nifty is concerned, we are looking at a near 0.4% gain for that as well. Now, that's the SGX Nifty that I was referring to. It opened mildly above the 10,500 mark, but right now we are trading close to the 10,480 mark, just slipped in trade a tad bit. But let's have a look at how the commodity space actually did, with oil being the primary focus. Oil prices actually declined more than 3% on Friday, but to slip below the 60 per barrel mark for the WTI. However, we are seeing slight bit of positive for both the WTI and Brent in early Asian hours. If you look at the metal space, gold prices have stabilized around the 1350 to 1320 for an ounce mark, trading with mild positive bias. But it was a bad day for commodities overall as far as the base metals are concerned. The index itself on London Metal Exchange ended more than 1% lower, with aluminium being the top loser. That saw a decline of about 2%. The others, copper, zinc and nickel, as well as lead as well, saw a decline of more than 1%, with lead being the only commodity which actually did act well, ended about 0.4% in the green. Let's move on to the flows picture that we had so that's how the actual flows have been. The top panel shows you the India domestic institutions, and the bottom panel is showing you the India FII provisional number. And we can see the last 5 bars. So the DIs have actually bought and FIIs have sold. No surprise there, with the market actually declining. We're looking at a 5,000 plus crore number for the DIs that actually they bought, and the FIIs that sold more than 3,500 odd crores. As far as the India market is concerned, we looked at the Nifty actually declining, but the Nifty Bank was interesting. The blue line on the screen, that's the Nifty Bank, and you see in the last it declined about 1.8%. That was the top loser in trade. As far as other sectors are concerned, we saw some bit of green come about for the Nifty Metal Index. But before that, let's address the volatility chart that we have. If we can have the India Weeks chart on the screen, so that you can see it was trading largely flat in the last month or so, in the range of about 14 to 16. But last week saw a real bump up in volatility, climbing as high as 22 and closing near just 20 levels. As far as the other sectors that I was mentioning, the Nifty Metal Index, that was the top gainer, gained about 1.3%. As far as losers were concerned, we had the Nifty Auto and the Nifty PSU Bank that declined almost 1% each. As far as the individual contribution is concerned, the Nifty actually ended 120 points lower, with HDFC Twins leading the way, followed by Infosys, ICICI and some others as well. But with that, Agam is here to take us through the futures and options space.
Absolutely, Jayesh. We did see weakness last Friday, but as the SGX Nifty is indicating that we're at least looking at a positive opening. That said, we did see shorts building up as far as the Nifty futures are concerned, with a 7% increase in open interest. The Bank Nifty futures, on the other hand, saw longs unwind. Moving on, when it comes to the India Volatility Index, that, as Jayesh mentioned, we have seen an uptick above the mark of 19, but the put call ratio remains the same, unchanged at 1.09. When it comes to the changes in open interest, despite the fact that the Nifty fell, we saw more writing in the 10,400 and 500 calls, and unwinding, of course, in the 10,500 put. And moving in terms of changes in the F&O ban, we have Balrampur Chini, which enters the F&O ban. On the other hand, Fortis Healthcare comes out. Of course, there's a lot of activity and news surrounding this counter as well. Hindustan Zinc sees fresh longs, along with other counters such as Adani Enterprises as well. But once again, all eyes will remain on the Nifty and whether or not it can hold on to the levels that we saw at close on Friday.
Stock of the day is Avanti Feeds. Good set of numbers reported by the company. If you look at the revenue top line growth, it's a 32% jump there, YOY basis, to a number of 706 odd crore as compared to 535 crore that we've seen in the corresponding quarter of the previous year. Net profit, there is a more than twofold jump there at a number of 101 crore as compared to 51 crore in the corresponding quarter. EBITDA, it's an operational efficiency driven bottom line performance, 154 crore as compared to 69 crore, and we're looking at a growth of 123%. Margins have shot up to 21.7% from a number of 12.9% that we've seen in the corresponding quarter. So what has led to the good set of numbers will be the low material cost and the good top line performance. Now, in low material cost as percent to your net sales, that number has come down to 69% from 75% that we've seen earlier. Also, higher other income has aided the bottom line performance of the company. If you look at the other income, that's a twofold jump there. We are looking, a threefold jump there. We're looking at a number of 16.2 crore as compared to 4.8 crore in the December quarter. Just to give you a rundown of what the segment revenue breakup looks like, to begin with the shrimp feed, that's where the growth lies. It's a 35% year-on-year jump at a number of 551 crore. Processed feeds too has seen a good 20% rise on year-on-year basis. For power business, that's actually weighing down on your EBITDA, on your top line front for that matter. If you look at the EBIT breakup, there also you would see the major profitable business is shrimp feed, which has registered more than 165% year-on-year jump at a number of 135. Processed feeds for that matter has seen some decline and has actually weighed down on the EBIT performance of the company, and also power business has been a drag for this company. Well, with that, let's toss it over to Saloni and Jayesh for commodity and currency market updates.
Thanks for that, Nikki. Talking about Indian rupee, it weakened to a fresh 2-month low on Friday, and it ended at 64.40 levels against the dollar. Now, the home currency extended losses for the second straight week, and it depreciated by a good 34 paise against the dollar, or it was lower by 0.5%. Meanwhile, a rally in India's foreign exchange reserves continued for 6th consecutive session, and it touched a record high mark of $421 billion for the week ended 2nd Feb. All eyes will be on CPI and industrial production data today. It will affect the currencies market domestically. Well, speaking about the bond market, bond extended gains for the first weekly advance in a month after yields dropped 7 basis points last week to 7.49%. On the global front, dollar index ended higher near 90.45 levels, and it was up almost over 1.45% for the week as 10-year US Treasury yields climbed over 2.9%. Lastly, coming back home, dollar rupee is trading at 64.22 levels against the dollar in a non-deliverable forward market, which indicates a positive opening for Indian rupee in today's trade.
Well, amongst the stocks that we're tracking today morning is ONGC, where an Indian consortium has is going to be buying 10% stake in offshore Abu Dhabi concession, and that is for a price of $600 million. Now, this Indian consortium consists of ONGC, ONGC Videsh, IOC, and BPCL's Bharat Petro Resources. So keep an eye out on these names. That apart, we're also tracking Cadila Healthcare, where the US FDA has completed the inspection of its Moraiya facility, at the end of which no 483 observations were issued. We are also tracking Ajanta Pharma on the same lines, where the US FDA actually inspected the company's formulation facility at Dahej, and again no Form 483 observations were issued after that. So some relief for both of these pharma companies. We're also tracking Dredging Corp, which has secured a contract worth 31 crore. So you might see some reaction on that counter. We're also looking at Amtech Auto. Now, this is on a business standard report which says that Liberty House has submitted a revised bid for the company after the earlier bids by Liberty House and Deccan Value investors were rejected because they were below the reserve price of 40 billion. So keep an eye out on Amtech Auto. And lastly, on the back of bulk deals, we're tracking a company, Awadh Sugar and Energy Limited, where investor Anil Kumar Goel bought 0.5% stake in a bulk deal on Friday. The stock already ended about 13% higher, but let's see if it inches up slightly further in trade today. But with that, we also have Sajid Mangat, who is joining us to talk about the Singapore Stock Exchange, which has decided to drop its own products reflecting Indian markets.
That's right, Shraddha. Singapore Stock Exchange, SGX, came out on Sunday and said that it's going to, come out with its own portfolio of products which will mirror the Indian market. This follows Friday's joint announcement by both 3 stock exchanges in India that they would be terminating that licensing agreement with all offshore exchanges, wherein BSE has an agreement with the Dubai Exchange for its Sensex futures, and NSE has an agreement with SGX for Nifty futures. The entire genesis of this is SGX starting 50 stock futures on its platform, and that led to fear of the entire volumes getting fragmented. The entire move by Indian exchanges was to ensure that consolidation of of trade happens within India. SGX on its part has said that they will come out shortly with the new products, so that they are which allows continuity for its global clients and across time zones. SGX will also be partnering with NSE to come out with some products for the GIFT City, which is the International Financial Services Center in Gujarat, and as and when that happens, they will announce new products there as well. We also have Vishwanath Nair, who will talk about the SBI results.
India's largest lender, State Bank of India, has reported a surprise loss of more than 2,400 crore for the quarter ended December 31st, 2017. Now, according to the bank, most of this happened because of a large divergence in the NPA reporting for FY17. Now, as you know, a divergence occurs when the RBI's expectation of gross NPA for a bank and the bank's own expectation of gross NPA for its own books. When there is a wide divergence between the two of them, the banks have to disclose it. Ideally over 15%, then the banks are forced to disclose it in their results. Now, according to the State Bank of India, this divergence has come into about over 23,000 crore just in the gross NPA segment. As far as net NPA divergences go, they are over 17,500 crore. So massive divergences coming in from State Bank of India. If you remember last year in FY16, there were a number of divergences reported by some private sector banks such as Yes Bank as well as ICICI Bank. At that time, the mark for a high divergence was set at close to 5,000 or 6,000 crore. But now with SBI's 23,000 crore divergence coming in, it is clearly outperforming on the NPA front as compared to its private sector peers. Now, what the bank says that is apart from this divergence, there were also issues because of the hardening bond yields. The bank reported an M2M loss of mark-to-market loss of nearly to 3,500 crore, which has also impacted its net profit for the quarter. There was also 700 crore wage revision hike impact that was felt on the provisions for the bank. Now, according to the bank's management, FY18 has been pretty challenging. It has been a challenging year, but FY19 seems to look very good. According to the bank, it will be able to maintain its credit costs at about 2%. That is what the chairman Rajneesh Kumar has been saying. He's saying that the loan growth will also improve along with the MSME and retail loan growth because those will prop up the loan book for the country's largest bank. According to SBI, in FY19 they have an internal target of credit growth of about 10.3%. Now, when asked, the 10.3% seems a little low as compared to some of their private sector peers. SBI says that considering it is the largest bank with a loan book of nearly 19 lakh crore, a 10% growth is still pretty large for a bank of its size. Apart from that, it expects the NPAs to gradually come down and FY19 and 20 to look much better than what FY18 is looking like currently.
Okay, so now brokerages have taken into account the weak third quarter numbers of SBI and also the 8,800 crores of capital infusion that it will receive under government's PSU bank recap plan, and hence they have tweaked their estimates and target prices. Now, it's a mixed picture as far as brokerages are concerned because most have retained their target prices, but you will also have some of the brokerages which have actually trimmed the target prices by up to 10%. We have Motilal Oswal, which has maintained the buy but cut the target price from 450 315 to 375. They said that while the asset quality has disappointed, they're expecting gradual recovery over financial year 2019. And they said that the purging of the residual assets, stressed assets, will still remain an overhang on the stock, at least in the near term. They've trimmed the FY 18, 19 and 20 earnings estimates by 75, 20 and 22%. On the other hand, you have Axis Capital, which has maintained a buy, but again cut the target price from 380 to 350. They have trimmed their FY 18, 19 estimates by 20 to 60%, but they have said that they will be tracking deliverables on growth, recoveries and any write back of provisions from the NCLT cases, in which case that could give an upside to their estimates. JP Morgan has retained a neutral with a target price of 320. Again, they have also said that the weak set of results could remain an overhang on the stock price in the near term. Edelweiss has maintained a buy, but contrary to the other brokerages, they have hiked their target price marginally from 399 to 420. Now, they've said that while a positive asset quality surprise came in from SBI in the second quarter, slippages in this quarter have gone back sharply to 5.7%. Having said that, the overall stressed assets are still contained at 13%. This is so because most of the slippages have come from within the stressed pool itself, but they have trimmed their estimates by 65 and 16% for FY 18 and FY 19. They believe that the government's recap allocation will cushion any asset quality swings and arrest net worth erosion. Additionally, the robust traction in the capital markets business actually lends some comfort, and hence on the back of factoring in that capital infusion, they've hiked their target prices. So broadly, it's a big mixed picture, but you could see the stock opening lower in trade today.
Well, on the primary market, Aster DM Healthcare's IPO opens today. Now, this is the fifth IPO of 2018 and so far the largest one. Now, the company is looking to raise as much as 980 crore rupees at a price band of 180 to 190, and at the upper end of the price band, it is 190. The company will be valued at close to 9,600 crore rupees. Now, the IPO is a combination of fresh offer and an offer for sale. Now, in the offer for sale, the promoter is selling shares worth 255 crore rupees, while the company is raising 725 crore rupees in the fresh issue, which it will use to buy, to repay its debt and to buy medical equipments. Now, if you see, Aster DM Healthcare is one of the largest private healthcare service providers in Middle East, India and Philippines. The company generates most of its revenue from Middle East or the GCC states or the Arab states. You can see here clearly, but over the period of time, the company has increased its revenue from India business from 11% in FY 15 to 18.5% in the first half of financial year 2015. Now, the company operates in three different segments, that is hospitals, clinics and pharmacies. Now, it gets 49% of its revenue from hospitals, 26% from clinics and 25% from pharmacies. Now, the company has around 323 operating facilities in 9 different countries, of which it has 19 hospitals with a total beds of around 4,754. Now, the company is looking to expand or build 10 new hospitals, which will add approximately 1,727 beds to its total beds. Now, if you see, Aster DM has a bunch of listed peers, but Apollo Hospitals and Fortis are the nearby peers given the size of the company. Now, if you see the financials of the company's revenue and net profit grew at a compounded annual growth rate of 32.5% and 21.3%, which is very high when compared to its peers like Apollo and Hospital. But its financials, that is Aster DM's financials, are a bit inconsistent, because in the financial year 2016, the company had reported a loss, and in financial year 2017, the company could report a net profit because of an exceptional gain of 596 crore rupees. As of first half of financial year 2018, the company has yet again reported a loss. Now, if you see the EBITDA growth rate, it is far lower than that of Apollo Hospitals. Now, coming to the return ratios, the company's return ratios are not that impressive. Return on equity stands at around 10.6%, return on capital employed at 0.2%, and return on asset at 2.9%. Now, on the hospital business side, if you see, the company's occupancy rate is the lowest among its peers. It stands at around 60% as compared to 64% of Apollo Hospitals and 75% of Fortis. Also, the company's average revenue per occupied bed per day stands at around 1,52,000 for the financial year 2017. Now, lastly, on the valuation side, if you see, the company's price to earnings is not that expensive when you compare with Apollo Hospitals, but is expensive when you compare with Fortis Healthcare. On market capitalization to sales, it is cheaper when compared to peers like Apollo Hospitals and Fortis, but on EV to EBITDA and price to book, which are more important metrics for a hospital business, the shares are offered at a very expensive valuation when compared to Apollo Hospitals and Fortis Healthcare.
Well, Tata Steel has reported good set of numbers, operationally strong. Bottom line seems to be a miss. That's because of the provision. Indian business has been a beat. Disappointment has come through from the European numbers. Just to give you a quick rundown of the numbers, revenue has seen good 21% growth at a number of 33,446 crore, way above the estimates of 32,000 crore. EBITDA is up by a 57% for this company at a number of 5,696 crore as compared to an estimate of 5,100 odd crore. Net profit at 1,294, although is a multifold jump, but then is lower than the estimates of 8,275. That seems to be a little lower than what we were working with. Now, the provision in the Indian business for around 1,115 crore from the Indian operation side has mainly led to a little disappointment coming through from the bottom line. But then operationally, we're seeing a good performance. Indian steel business Q3 EBITDA per ton is at a 12-quarter high at a number of 14,024. Volumes are up at 10% year-on-year for Indian steel business at a number of 3.3 MT, and higher steel realization and benefits of higher volume has actually percolated down in the operational efficiency of the company. Macquarie, on back of this, has actually upgraded the stock to outperform from underperform and has raised the target price. It has said that stronger balance sheet along with focus on domestic growth has warranted a re-rating, and JP Morgan and Tata Steel, while maintaining the overweight, has maintained the target price also at 1,015. It says that the Q4 margin should be higher, but then the volumes going forward could be a little bit impacted in the next quarter for Tata Steel.
GAIL is expected to come out with its numbers today. Now, the company is expected to report a steady quarter. Revenues are expected to be higher by 11%, while net profit is expected to fall by 1.2%. On the EBITDA front, it is expected to be higher by 3.6%, while margins are expected to contract to around 15.6% in the third quarter of financial year 2018. On the operation side, the gas transmission volumes are expected to remain flat, while the petchem volumes are expected to be 8% higher. Now, the factors that will lead to such an earnings are EBITDA is expected to rise because of the higher petchem volumes and realization, and volumes are expected to be higher because in the third quarter of financial year 2018 their plant is expected to run at a full capacity. Now, if you see on the LPG, realizations are expected to remain strong because of higher realizations, while the realizations for petchem and LPG segment are expected to improve on account of higher crude oil prices. Now, the transmission segment EBIT could soften a bit in this quarter because of flat volumes and higher operating costs. Lastly, the net profit of the company is expected to fall because of a sequentially lower other income.
I think it will happen. It will happen because one thing about a private equity is they are putting money and after some time they take out. This is the nature of it. They must be looking for opportunities on it. I'm sure somebody will be coming up fast.
Sure, sir. Also, one other thing that there has been a lot of talk about is the National Health Protection Scheme. So,
yes, which finance minister announced.
Correct.
Yeah.
So, after Pradhan Mantri Fasal Bima Yojana, this would be the second biggest scheme at such a large scale that will or may see implementation going forward. So, how has been the experience with crop insurance scheme, and how do you think National Health Protection Scheme will be implemented?
See, National Health Protection Scheme, probably you can compare with the Prime Minister's Jeevan Jyoti Bima Yojana, Bima Suraksha Yojana. That's for individuals, not for crop it is coming. This is for individual and the families. The government has announced for 10 crore. Quite exciting. That's what I heard it. I said, I mean, anybody who is working with insurance, we had some inkling on that thing even before that. It's quite exciting news. Implementation will be a challenge because 10 crore families are to be enrolled into that thing. 50 crore people are coming. Big outlay is there. However, we had an experience of running Rashtra Swasthya Bima Yojana, a very smaller level. Some states are having some insurance schemes. Some degree of expertise is there in that thing. And on the base of this expertise, I think it will be an achievable target.